thank you for joining CryptoQuant's Twitter space. So, David, what do you think about what have you prepared for the on-chain 2021 retrospective and looking into 2022?
We see a much more diminished year in terms of volatility. We also see a new distribution of cohorts, at-risk cohorts, in terms of what's becoming. So at this point in time, I guess you would have three different types of players in the Bitcoin specifically, in the Bitcoin market. I guess the first one would be mainly OG early adopters who still hold a lot of the balance, the total balance of the Bitcoin circulating supply. Then the institutional players who in proportion have less market share, you could say. That's mainly because of the timing they got into the market, right? At that point, major, by today's standards, major whales had already entered the market in, different cycles, way back to 2013 or 2011. And then just retail, as always, one of the main drivers, with a much more diminished, let's say, participation in the market. 17, right? If we see the later stages of 2017, it was a huge market driven by retail, irrational exuberance at the later stages of the ICO boom. That has diluted at this point. So the market is driven by mostly OGs or profit taking, pretty on the heavy side since 2018, even early stages 2018. And then the market movements have been mostly up and down by the new institutional adopters who are pretty much, they behave much more like you would expect a traditional market, in the sense that tops and bottoms are perhaps more produced, intertwined by events of volatility to the upside and downside, and then huge periods of or long periods of accumulation and distribution for several months, right? I mean, during the year, basically, we had at the beginning of the year to the upside, and then around May to the downside. Not that common for Bitcoin historically to be so reduced in terms of ratioing consolidation versus trending movement. And that pretty much is suggestive of how institutional players act in any given market. I expect that to continue to the future for sure. Even if we go back to just the last year, right, or 2019, which was extremely volatile, hard to trade, filled with gray or black swans all throughout. This year was much more, let's say, relaxed, and let's say it was easier to navigate, right? But I think that has also kept retail much quieter. The main aspect we're seeing, which is atypical to previous markets, is so we have a healthy amount of buying, very quiet and strategic buying whenever we have any major downside, but still a lack of momentum in network health related metrics. So let's say active addresses, hash rate, transaction count. All of those are not heavily related to, let's say, a specific buy or sell signal, because sometimes they decouple in correlation with price, or they're not as specific to generate, reliable buying or selling signals. But nonetheless, in aggregate, they show a confluence of lack of activity relative to price, what we would expect to a later stage bull market. For people who are new to the space, December, the December month, perhaps the January month, in any bull market, at least in the few samples we have, is those are moments of extreme volatility to the upside. I think this is long-term healthy. It denotes that the market's going to be mostly owned by institutional players, especially in month-to-month price movements, with some profit taking from early adopters, but a much more diminished role coming from retail players who perhaps don't find that they don't find attraction to Bitcoin per se. The lack of price volatility they would expect to the upside, like they did in 2017. But that also prevents perhaps more, sustained or corrective periods of full-blown bear markets that last from a year to 3 years, as we've seen before.
So you mean the increasing of active addresses could indicate we're kind of bullish right now?
I usually don't use, let's say, specifically one single metric like active addresses, right? Active addresses perhaps in and of itself does not give you the great hint, but I'm noticing much more activity, let's say, buying activity at the exchange level. So whenever your spot is more expensive than speculative contracts, that's very bullish. So right now it's pretty atypical. For the people who stick to a cyclical market, 4-year cyclical market in Bitcoin, I mean, by now something different has happened already. It's completely atypical to see such a low volatility, yet healthy, right, market at the later stages of a 4-year cycle. That has never happened before. You always see, extreme irrational exuberance at these stages. So it's good in the long term, but it's not as fun, let's just say, for new investors who expect 2x, 3x pump in a couple of weeks, as they saw in 2017.
I think basically Bitcoin valuation model has been changed, like based on its narrative. A few years ago, Bitcoin was a P2P payment system, right? So the number of transactions and number of active addresses is very important to evaluate Bitcoin network, like MVT ratio, I would say. But nowadays, you like you mentioned, the number of addresses and transactions are not that related to the price actions. And I think basis ratio, futures price is more cheaper than spot price right now. I think it's a good thing for the long term, because it would indicate there are buyers in the spot market. But I'm pretty afraid of is that I haven't seen any new buyers in this market. Do you have any clues to see new money inflows to the market? Like,
for the most part right now, I'm seeing more holding than buying. And perhaps I see some reaccumulation. But yeah, that's the way I would put it. It's more holding than buying, and that's certainly not the same thing. I mean, holding pretty much sets healthy floors for a corrective market. And if you have that mixture, let's say low distribution or selling, high holding but no new buying, the result is
Yeah.
a sideways market, literally.
That's what's
you know.
happening, right? No one is selling and no one is buying. That's why price is like going sideways.
Yeah, exactly. That's the result is pretty obvious. It's just more consolidation, which is healthy, for sure. The thing about an extremely prolonged period of consolidation, let's say, to give you an example, 2018, the first half of it, after the bubble, the ICO bubble in 2017. So the market collapsed from about 20K to, I think the first impulse was to 6,000, I believe, and then went back up to 10,000 and continued to range around the 6,000 mark, right? For, I think it was a little over 6 months. So it's a long period. Whenever you get that on any long-term chart, that severe, the severe period of low volatility. Well, one, the market corrects either in price or in time, right? For any tone-based listeners, you already heard that, which is a very good rule of thumb, right? Whenever you have punishment in time or in price or a little bit of both, that's healthy. But the longer you have a low volatility market, the higher the probability that that market is going to be extremely expansive. And the first principles explanation for that is pretty obvious when you look at it. What happens? It's like a self-fulfilling prophecy in a way. So what you get, what you get in a high volatility market, the books get wiped. The bids and asks get completely wiped. People are much more risk averse during those periods. So they decide to stop, pretty much betting on the market or even on a spot price, right? But when you get low volatility, everything compresses around price. Orders, stop losses, bids, ask, everything compresses around price. So whenever you have a fundamentally strong event that impacts the market, you get a cascade of that always goes into the, you never know what's enough until you know what's more than enough. So whenever you have low volatility, all the orders, all the speculation is extremely compressed around price. You get like any spark that sets that off, and it's like a chain reaction that produces a pretty huge pump or a crash. And we saw that in 2018, right? Volatility was historically low. I think it's all-time low that time, and the market collapsed from 6,000 to around 3,000, right? So that's the danger, right? Now, the other factor that played out that time and can still play an important role during this market would be you have the spot price and the expectations of it relate to volatility. Another thing that correlates with low volatility is high open interest. That happens specifically in Bitcoin, which is quite easy to track, right? So orders rise, and the speculation rises at moments of perceived low risk, meaning low volatility, and that in itself creates high risk, where open interest pretty much keeps rising, as we've seen. We're actually seeing that right now. And that sets off a liquidation event that obviously creates volatility. I mean, that's actually, for the most part, the effect that derivatives have in the Bitcoin price, even up to date. You can explain long-term to mid-term movements fundamentally via on-chain, spot price, spot behavior. But in the short term, let's say a correction, as we've seen recently, right? You can explain it in terms of liquidation events sets off by high open interest, right? That's the real effect that derivatives create in the market. It's not, a systemic risk in the sense that we're going to have a new, like there's no new bear market that you would get just out of derivatives. That's completely ridiculous. You get a bear market because no one's buying spot, right? But you can get a correction for sure, like the recent one, 2018, that same example. If you would translate that to now, you may get some hints of lack of momentum. And at the moment, derivatives in general are extremely bullish, actually, right? Open interest keeps rising, yet the derivatives remain at discount on their spot, right? So the expectations is you would see upside in terms of price. Now, this may flip, right? We may keep consolidating after a few months and have expectations of, a very bullish market, consistent funding rates, and all that stuff. And then at the peak of low volatility, we see a shift, and then the narrative changes, right? So it's hard to make that expectation.
We are now moving on to our second phase of discussion between David Peull and CryptoQuant verified authors.
What is your favorite on-chain metrics that you use to map or gauge the demand in the market, besides the active addresses? Because I think that's obvious, but...
Well, MVRV, but C-score version. I use it more for a wider cycle, very long-term analysis. For shorter to mid-term analysis, SOPR, I look at it, for the most part every week, if not every day or two. I also look at exchange balances just to keep an eye on how if they the whale institutional players are still holding their positions. I look at the inflows and outflows from exchanges and the ratio of it. The other ones would be perhaps dormancy, Coinbase destroyed, stuff like that, just to keep an eye on if there's a lot of potential selling pressure in the market. Keeping an eye on old coins and making sure that they're not being circulated back into the market.
What's your thought about the Lightning Network and its effect on Bitcoin valuation models in the future? Since it's not an on-chain, how will it affect the models in the future if large number of transactions of small amounts happens in the second layer, not on-chain?
I think that's a long way to go. I would say it would start to affect metrics. Let's say when it gets to over 200K Bitcoin, something like 1% of the supply. When will we get that? I think that's for the next cycle. I don't think it's going to happen on this one.
Is there any metrics that you like from our service, from CryptoQuant? What's your most viewed metrics from our service?
I like the particular angle of CryptoQuant that integrates a combination of on-chain and exchange level or market level metrics. I actually like the iteration you guys gave to the miner outflow multiple, which is a C-scoreized version of it. Correct me if I'm wrong, right? What miner outflow index? That's the correct name. Is that right?
Yes, miner's position index. That is correct.
Exactly, which is a yearly C-scoreized version of miner outflow multiple, right?
Mm-hmm.
Yeah, I like that one. I actually think that's a precise example of how a lot of with a lot of these metrics, I mean, for the most part, statisticians hate the fact that you have to extrapolate additional functions to your previous formula. Let's say applying a C-score to MVRV as opposed to keeping it just as a ratio. But for the most part, C-scores are very useful in adjusting for volatility, pretty much any metric, not just MVRV or miner outflow multiple. I think it's the way to adjust for volatility, any on-chain metric. I think you guys have a few metrics that are I don't find in other service providers. One of mean coin age. I think that's one of them. So I get that from you. Well, at the very least, I get that from you. That's for sure.
Yeah, we provide in Coinage and some Coinage too. Yes.
As just a normal retail investors, we always wish to spot some institutional movements, and I think the closest metrics that is available to retailers is the Coinbase Premium Index. Do you think that this just approach to spotting institutional movement is appropriate?
Yeah, for sure. So I look at it perhaps twice a month, something like that, just as a general context, or maybe after a corrective or impulsive movement, something like that. I do think that Coinbase is at exchange level extremely important, and CME, as two major institutional hubs for diagnostics institutional behavior. Also, to keep it, I think it would be simpler for retail. Derivatives premium discount, but calculated via BitMEX. BitMEX is a little bit special to me as compared to Binance or Bybit, despite the fact that it has lost a lot of market share and open interest. But it's important because I think it has the most robust oracle or index price.
Thank you for all of your time, especially David, Key, and all secure verified authors who has joined the call and the audience who has attended this event today.